Good afternoon. Thank you for joining us at 2 o'clock today. My name's Alex Jones, and I'm the president of UB Community Development. We're a community development entity headquartered in Atmore, Alabama, serving the state of Alabama and the state of Florida in the New Markets Tax Credit program. I have with me today also Tyler Enda with Baker Tilly. Baker Tilly is a national accounting firm, and I will turn it over to Tyler and let him introduce himself and his firm.
Hi, good afternoon, and thank you, everyone. As Alex said, I'm Tyler Inda with Baker Tilly. I'm a principal at Baker Tilly and help lead our new market tax credit and capital formation services. Baker Tilly is the 10th largest consulting CPA firm in the country. We've been involved with the new market program since its inception, and have closed over $14 billion of deals in the new market tax credit program and are very experienced in all of the other federal tax credits, including historic tax credits, low-income housing tax credits, and renewable energy tax credits. Today, we're going to talk to you predominantly about the new market tax credit program. As Alex alluded to, United Bank and UB Community Development have been one of the most prolific recipients of new market tax credits over the last several years, and want to talk about how to identify opportunities and how the program works. So the program was actually started under the Clinton administration with a first authorization under President Bush. So it's had bipartisan support. It's a federal program that's focused on stimulating commercial investment into low-income communities. It's overseen by the CDFI fund. Some of you may be familiar with the CDFI fund, others may not be. The CDFI fund is a division of the Treasury Department, so similar to the IRS, which is another division that most people don't like very much, candidly. The CDFI fund is another component of that Treasury Department. And the way the program works is that community development entities, or CDEs, apply to the CDFI fund for an allocation of new market tax credits. These CDEs come in various shapes and sizes. So as Alex pointed out, United Bank, which is a CDFI bank, has a CDE. Large financial institutions such as JP Morgan Chase, US Bank, etc., also may have CDEs, as well as local nonprofits, regional nonprofits, and some local municipalities have CDEs. So these CDEs apply to the Department of Treasury for an allocation of tax credits to fund projects in low-income communities that stimulate economic development, job creation, community services. So when we talk through what is, a low-income community, that's kind of prevalent for the new market tax credit program, it is very specific. It is based on census tract data. Currently, the program is using 2020 census data, and it'll use that generally probably 6-7 years past the 2020 census. Then it'll typically in 2027 or so switch over to 25 census data, and likewise going forward. So in order to be a low-income census tract, you have to have a median income at or below 80%, or a poverty rate that is 20% or higher than a poverty rate 20% or higher. And then when you start getting into more distress criteria, that's when the unemployment rate comes in as a factor. You can look up what a low-income community is on United Bank or the CDFI Fund's webpage. So as you'll see on the next slide, there is a link to the United Bank website that'll allow you to just click in and verify whether or not your census tract that you're looking at is a qualified new market tax credit census tract. As you will see from this slide, the green census tracts highlighted here are qualified census tracts within the kind of Alabama region. So there's a lot of qualified census tracts for consideration. Is Alex will highlight as he goes through kind of how the program works. The one thing that is needed is that you are in a low income community, and it is black and white. So either you are based on your census tract or you are not. And so this data and the mapping tool United Bank has will help you determine that eligibility factor. Then I'll turn it over to Alex to kind of walk through what a community development entity is in more specification and the program.
Great. Thank you, Tyler. So what is a community development entity? So it is an organization by its charter that is focused upon serving low-income communities with its activities. And as Tyler said, there's different flavors of CDEs, municipalities, banks or bank-related entity like UB Community Development, nonprofit, and other for-profit entities. Each CDE has its own defined geographic service area. UB Community Development serves Alabama and the state of Florida. There are some that are national CDs, so they serve clearly the entire United States. There are some that only serve certain municipalities, like Metro Atlanta, for example. So it really depends upon that CD and their service area. And then some CDs have specific mission areas they're looking to serve. So some CDs are looking for green energy projects. So they're looking for carbon footprint mitigation, clean energy, etc., or environmental impacts. Some are solely focused upon affordable housing, for sale housing for single families. Some are focused upon healthcare transactions solely. So it really depends upon the CDE, the geography they serve, and then the type of projects they're looking to serve and the ultimate outcome of what they're trying to achieve. UB Community Development is the only CDE headquartered in the state of Alabama, serving the state of Alabama. So as we look at, well, how does the program work? As Tyler mentioned, the program was created back under the Clinton administration, and annually thereafter, the CDEs that are designated by Treasury, and that's a designation that we have been received from the Department of Treasury, apply to the Department of Treasury to receive the right to allocate these tax credits to investors. So it's a competitive annual process where we get tax credits awarded to us. Then we look at eligible projects in our service area that meet our mission and determine, what are the most impactful projects that we can allocate our tax credits in to support those projects. And then once we've done that, then we kind of move into what we'll call the closing phase. And at that juncture, we would actually sell those tax credits to a third-party investor. And as it says, we normally work with large banks, but we also do work with a wide range of community banks in the Southeast that will buy credits as well. And so we work with them in closing and structuring the transaction, as we sell those tax credits. So as I mentioned, the investor purchases the tax credits and makes an equity investment. So at closing, when they purchase those tax credits, they make an investment, a cash investment into the transaction in return for the right to receive and take those tax credits on their federal tax liability over a 7-year period. Also, as we think about how a deal gets put together, and we always talk about capital stack, how does the project put its capital stack together to allow it to come to fruition? To fund the new market tax credit transaction, there's an entity that we call the leveraged lender that puts debt into the structure. That debt can be sourced from a bank, or if they have sufficient liquidity, they can self-leverage that transaction. But the net of it is the new market equity that results from the sale of the tax credits, and then the leveraged loan funds this investment fund in an amount equal to the amount of tax credits that we allocated to the project. So we'll show some diagrams here in a second. This will kind of all make sense once you can see the boxes and the arrows. But so that investment fund that's created for the purpose of this transaction then drops down, what we call a QEI, qualified equity investment, into a sub CDE. So every time UB Community Development does a transaction, we create a new entity that's an affiliate that allows the money from the tax credit investor and the debt to flow down into it. And so then that sub CDE that we have created, as it says, ultimately makes two loans down to the qualifying project. And we call the qualifying project the Qualic B. And that's the qualified active low income community business. And obviously, low income community ties back to what Tyler mentioned earlier and about the eligibility requirements of that project being located in that low income census tract. Tyler, I'll hand it over to you to talk through the structure.
Yeah, so you see a lot of boxes on the diagram in front of you that Alex kind of highlighted. And so, the first thing before going through these boxes and the structure is that this is all set up to provide a portion of to allow the new market tax credits provide a portion of the capital stack. Generally, as you'll see as we go through the next slide, that portion is 20 to 25% of the capital, and it's really the most difficult capital generally to receive for a project, which is the subordinated capital that you got your bank debt, you got maybe some owner's equity, and you have this gap in the project. Well, the new market tax credit capital really comes in and fills that gap. And in order to do that, we often use this leveraged new market tax credit model that you're seeing on the screen and kind of the components that Alex just talked about. So on the upper left side of the screen, you'll see the leverage lender entity that Alex alluded to. That entity is really aggregating your other sources of capital. So that could be bank debt, that could be capital campaign funds if you're a nonprofit, that could be some owner's equity, any other kind of sources of capital that are coming into the project. It's going to lend that money into an investment fund. That investment fund is just newly created for this transaction. So no other activity was just set up for this transaction. Alex highlighted that in addition to the investment fund and the leverage lender putting debt into the investment fund, the tax credit investor is going to put equity into that investment fund. Its equity is based on the amount of tax credits it is purchasing from that CDE. So the CDE that went to apply to the Department of Treasury, specifically the CDFI fund, was awarded an amount of allocation. It identifies a project that it would like to fund based on the impacts that that project is going to have on the low-income community, and it will allocate tax credits to the specific project. Then the tax credit investor will purchase those tax credits. You'll see some of the math here shortly, but that tax credit investor is really purchasing credits, and that's what its yield's going to be. So if it's buying $1 of credits, it may pay 80 cents for those credits. Those credits are taken over a 7-year period, and that's the yield the tax credit investor is getting. The money from the leverage lender and the tax credit investor who puts its money into the investment fund as equity flow down to a newly created entity called the sub CDE, which is managed by the CDE that received the award. And that sub CDE ultimately makes loans down to the Qualic B, which is that qualified active low-income community business, or really the borrower in the new market tax credit structure. That borrower is oftentimes a special purpose entity to ensure the assets of that borrower are located in a low-income community. So for example, if you're a industrial manufacturing company, you may have manufacturing facilities, throughout the state or throughout the country. You would set up a new entity specifically for that location that's in a qualified low-income community. That SPE entity would be the project borrower. Similarly, for healthcare providers, et cetera, and others, often you're setting up that SPE to locate that specific project in a low-income community. So those are all of the players in this leveraged new market structure. I should highlight that this structure, and Alex will get to some of the dynamics of this later, but this structure is really typically used for larger transactions, $5-6 million projects or north of that, because you're limited to project costs for how much new market tax credit allocation you can receive. So on the next slide, you'll see kind of the math of the new market tax credits. So as I was alluding to, if a CDE provides 10 million of allocation to a project, it's not really $10 million of tax credits. It's $3.9 million of tax credits. Those tax credits are taken over a 7-year period by the tax credit investor, 5% for the first 3 years and 6% for the following 4 years to get to that 39% amount. And so, as I highlighted, the tax credit investor is really getting its yield from buying those credits at a discounted rate. So the market right now is between kind of that 75 to maybe 80 cents, usually 75 to 78 cents. So what you're seeing in this example is $10 million of allocation results in $3.9 million of tax credits. The tax credit investor is paying $2.9 million or 75 cents for that stream of tax credits. It's going to take over 7 years. And then with these new market tax credit leverage structures, there's several tax opinions and a lot of legal counsel involved. If you've ever worked on a bond financing or anything where there's, several tax opinions needed, it's similar to that here. So when you net out legal fees, closing costs, et cetera, the benefit down to the project is going to be roughly 20 to 25% of whatever that allocation amount provided to the project is. And I'll let Alex kind of now walk through a diagram with numbers so you can really visualize what we're talking about here.
Yeah, so as we look at this transaction, this is again, we're going back to, the $10 million-ish transaction, and, following the math, Tyler covered on the prior slide, you can see the 3.9 million, the $3 million in equity coming over at closing from the tax credit investor into the investment fund. And then we've got the $7 million leverage loan. And I'll just point out, as we think about the capital stack, how is that leverage loan funded? Is that coming from, primarily equity that the company has accumulated? Is it a combination of equity and bank debt? We've worked on transactions where that's equity, bank debt, and then let's say there's some state funding. It can just come from grants. It just depends on the sourcing of that, how that's put together. And then you can see the $10 million QEI. That's a qualified equity investment the investment fund makes down into our affiliate, a sub-CDE. And then that drops down to the QLICs, so qualified low-income community investments. So if you like acronyms, this is a good program. And you can see in there, notice the A note and the B note. And the A note traces back to the leverage loan, and then the B note traces back to the new market equity minus the fees that Tyler alluded to earlier. So
Hey, Alex,
yeah, go ahead,
before you
Tyler.
move on, have you ever used like USDA financing or any of these other sources as leverage on these projects? Can you combine it with some other programs?
Oh, Tyler, it's funny that you ask. Yes, and so we have used we've used several different flavors of USDA funding. We've used USDA Rural Development, BNI. We've used USDA Rural Development Community Facility dollars. That structure is a little more complicated than this one. And we have also used bond financing from county authorities or municipal authorities as the source of the leverage going into these new market transactions. So good question, Tyler.
Okay.
So moving on, as Tyler said, that prior structure is $5 to $6 million up in total project expenditure. We also, every time we receive an allocation from the Department of Treasury, we set aside a percentage of that, and we do what we call small QLICI loan pools or loan funds. So, we take, in this instance, $10 million of our allocation, sell it to an investor, and in turn, they put those dollars into the investment fund, and then the bank makes a leverage loan into that investment fund, and then the QEI drops down to our sub CDE, and then we in turn make QLICIs to smaller borrowers. So, and you can see there, it says 1 million, 1.5, 2 million. There's a requirement under the code. These can be no more than $4 million. So this kind of allows us to bring the benefit of the new market program down to smaller businesses that normally would not be eligible or available to participate in the program. And the benefit of it is that $3 million that's helping fund this $10 million pool has no interest carry on it. So the investor is not looking to get any interest income off of that investment. So we're able to pass through down to the borrower a discounted interest rate, because if they're borrowing $1 million, they're only paying effectively interest on 700,000 of that $1 million. So I think as we kind of keep moving here, we've got allocation does not equal cash, right? So we receive these tax credits, and grants us the authority to allocate them to an investor, and then at closing, they purchase the credits, and then through us, we conduit those dollars into qualifying eligible projects. So, just want to be clear, as Tyler showed the math, $10 million of allocation does not mean you're receiving $10 million of financing through the structure. All right, so why do we do all this? As Tyler said, you saw the cost, and there's legal fees on top of this, and boxes and arrows, and it's complicated, right? On those standalone transactions, the ones that Tyler mentioned that are $5 and $6 million and up, and if you recall, you would have seen, and I mentioned the A note and the B note. So that B note portion has debt conversion in it. So as part of the transaction, at the end of the 7 years, the investors received all that stream of tax credits that gets them the yield they expected on their investment. At the onset of the project and the investor enter into a put call agreement. And for a put fee at the end of the 7-year period, the investor assigns over to the project that B note. And the way I often explain it to people is, if your mortgage company called one day and said, hey, if you pay me $1,000, I'm going to assign over to you the promissory note secured by your house. So you'd end up paying yourself back for your own mortgage. I think that's a deal you would take all day long. And obviously, it's a little more complicated than that, but if we distill it down to its essence, that's essentially what happens after the end of the 7-year compliance period. So, as a CDE, what are we looking for? If you recall back, we look at projects and make sure they meet our mission. So what are we looking for when we look at a project for determining if it's going to receive our allocation, right? So I'll start at the bottom. Brings new goods or services to underserved communities. So what does that mean? Some good examples are rural healthcare transactions. So, when we first started doing this, that was really not our mission where we thought we would be. But, those of you working in healthcare, and particularly in the state of Alabama, rural healthcare is tough. And those are great projects because it's bringing a service to an underserved community. We've also done several healthy foods projects for grocery stores and other food deliveries in food desert designated areas. So, that's kind of when we say goods and services, that's kind of what we're looking at there. And then, I guess the main thrust of what we always look for is attract and retain the skilled workforce. So we're looking for projects that create good living wage jobs in, underserved rural communities and urban low-income communities as well. And then also, we always talk about catalytic impact, and what we're looking for in that project. And a good example would be if we did a wood processing facility, for example, right? And so they're going to put a new mill in of some sort, lumber mill, saw, coal mill, paper mill, whatever it is. What's the additional impact of that? And it's pretty easily quantified. Those of you that live in rural areas and have spent some time around a sawmill, there's going to be a lot of trucking jobs, right? Because there's logs come into the mill, finished goods going out. And then even further than that, we're looking at, well, what's going on out in the woods? There's logging crews, and then further than that, right? There's the companies that help maintain all that logging equipment. And then even further than that, there's the stores that sell food and fuel to the people that are supporting that business out there in the woods that are actually pushing the logs into the mill. So that's, kind of the layers of what we're looking for when we make a determination on what projects we're going to support. So as we look at, the qualic B, and I'll reference back, that's the qualified active, focusing on the word active. It's got to be an active business, low income community business, right? So it's got to have its assets located in a low income community. And then there's this concept in the code called non-qualified financial property. We just say NQFP. And so the recipient, that qualic B, cannot receive this financing if it's got more than 5% of its assets in financial property. So cash, investments, receivables, note receivables, stuff of that nature. So we already hit on the maps tools we have out there, so you can go see if the geography qualifies. And I'll just say this: that's the first step always, right? Go map it. And is the census tract qualifying? Yes. And then we can kind of move to these other gating items that we have to look at when we're determining, does the project qualify? Real estate projects. So as we look at real estate projects, and I think I'll just jump back real quick here and say, the assets financed with the NMTCs has to stay in the qualifying census tract. So it often comes down to, real estate or fixed equipment, because, those things don't have wheels and they don't move out of the census tract, right? So mixed use developments are permitted. So if we think about mixed use, if you think about, retail on the ground floor and residential above, or maybe different structures in the same project, but so there's commercial use and there's residential use. And so no more than, so we call this the 80-20 rule that allows it to qualify, right, for that mixed use. And again, this is something, if somebody's looking at a project, we need to have a conversation early on and look at the structure of it to make sure it's going to pass that test. And then the second one is substantial rehabilitation. So if a project is acquiring a finished asset, so if they're just buying a building, right? If it's not going to be used owner occupied, then we have to show that they are doing a 25% rehabilitation to it based on their acquisition cost. So, if you're buying the building and you're moving your business in, that's kosher, right? But if you're buying it and then you're just going to turn around and lease it to a tenant, that doesn't work. You have to do substantial rehabilitation to meet that requirement. And now I'm going to turn it over to Tyler to hit on further qualic Bs.
Great, thanks, Alex. And so as Alex alluded to, community impacts critically important on projects. The kind of first item to check is, are you in a low income community? And then it gets a little bit more nuanced under the new market program in terms of, are you just in a qualified census tract, or are you in a highly distressed census tract, with the highly distressed census tracts being the ones that most CDEs are looking to fund. So the primary criteria for highly distressed census tracts are that the poverty rate is over 30%, median family household income is 60% or below either of the area median income if it's a MSA, or statewide median income if it's rural, or the unemployment rate is 1.5 times the national average or greater. And this is all based on that 2020 census data. Also, non-metropolitan census tracts, automatically assuming you qualify as a low-income community, are designated as highly distressed. One quick thing to note on non-metro tracks is that the CDFI fund for the New Market Program has its own very specific designation as to what is a non-metropolitan census tract. So you need to use the mapping tool to confirm. It's different than USDA, for example, definition of a rural or non-metro tract. So it's important to look at the mapping tools. So really, to be a great qualic B, you need to be highly distressed. Outside of these three items that would get you to highly distressed, there's also what is called secondary criteria that can get you to highly distressed. The two most prominent secondary criteria would be if you're in a low income, but it's not highly distressed area, and you're providing, fresh food and you're in a USDA designated food desert. Or the second one is if you're a healthcare provider and you're in a federally designated medically underserved area. So being highly distressed really makes for a great candidate. Is noted on the next slide. What makes for a good candidate is, just being qualified. So getting to that highly distressed qualification is helpful. You'll see on the following slide here that there's a breakdown on this map of qualified versus severely or highly distressed that you can utilize. So you can type in an address and see that. If you're only in qualified, you can reach out and see if to Alex or others to determine if that secondary criteria could get you to highly distressed. So a factor for consideration. And then last but not least, when looking at this, going back to the importance of community impact. So the project does, in order for it to be a good candidate, it does need to create jobs, provide services, or do something that's really going to have a tangible benefit on the community and receive community support and need the allocation. With that, Alex, I'll turn it over to you to kind of talk through briefly the different sizes and some additional examples of what makes for a good qualified B candidate.
Thanks, Tyler. Yeah, so I think we've kind of hit on this already. On the standalone, we mentioned $5 or $6 million. Obviously, with inflation, that number creeps up to what I call escape velocity. You need to get high enough CapEx to make the project make sense for a standalone. And then, out of our loan funds, under 150,000, it really doesn't make sense just because of the cost of funding the loan and the documentation with it. And then as we look at, job creation, and as I mentioned earlier, that's kind of, the main thrust of our mission is looking at job creation. So for every $100,000 spent, looking at one job being created. And so we kind of haven't talked about all the different types of projects we've done. So education facilities, we've done, college and university facilities, charter schools, we've done FQHCs, federally qualified healthcare clinics, urgent care clinics, hospitals, and community facilities. We've done nonprofit headquarters, farmers market, retail, so that would be grocery stores we've talked about earlier. And then obviously C&I, commercial and industrial, right? Processing facilities, manufacturing facilities, distribution facilities. I mean, you just kind of spans the gamut, the kind of projects we've done that fall into that bucket. And so, as we kind of wrap up here, again, got to map it. That's where we begin. Business not engaged in or leasing to an ineligible business. So we did not hit on that, and that's a good thing to mention. So there are businesses that are not eligible. So alcoholic beverage distribution, gambling facilities, golf courses. If you've ever been involved in SBA lending, they have what they call the SIN businesses. It's pretty similar to that list of ineligible businesses. And then project creates a tangible community and economic outcome. So, as part of the program, the Department of Treasury has awarded us, $400 million of these tax credits over the past few years. We have a duty back to them and to the taxpayers, right? Um, to, document what we've been doing with those tax credits. So, we've got to record and track that every year. And then finally, total project costs are not necessarily the thresholds for the CDE. Yeah, so what that basically is saying there is that there can be projects that have CapEx that is in excess of the amount of allocation we put into the project, right? So it could be, it's a $10 million project and it only receives $8 million of new market allocation. So they're funding above and beyond that. And I wanted to hit on also, the other facets of UB community development before we kick over to Q&A if anyone has any questions. UB Community Development has a community housing capital program where we do workforce and affordable housing using some innovative financing and funding structures we have. So, we've got a little more flexibility in the geography under that program. So if you have any need for that in your community, we'd love to talk to you about that. And we also do community facility lending. So as you see there, infrastructure projects, we've done roads, utilities, community centers, tornado shelters, senior centers, educational facilities, and then municipal facilities. So fire, police, healthcare. We received a number of years ago a $40 million credit facility from USDA Rural Development that we've used to fund some of those projects. And we have a little bit of that funding left that has to go into rural and high poverty and severe distress communities. So if you have anything that might qualify under that and are interested, you can definitely reach out to us for that. And on the next slide, you see my contact info. And obviously, if you arrived here, you received my email. So in the Zoom function, if you have any questions now, we could probably take a couple minutes. And if you want to type them in and pop them up, and Tyler and I can take a swing at them and see if we can answer them for you. So we'll pause there. Tyler, do you have any closing comments?
And I was just gonna say, we certainly don't expect you to fully understand the structures and all the programmatic requirements. The goal is really to help you, identify when this may be an opportunity, right? So bringing 20 to 25% of the capital stack with it, really maybe forgiven through this put call at the end of 7 years is a great tool and desperately needed for a lot of projects. So the hope is that you're, working in your local communities, you're able to identify when a project may make sense for the new market tax credit program. And that's when I would say, certainly feel free to reach out to Alex and others, and we can guide you through, okay, here's exactly how the structure would work. Here's, all the other kind of elements of it as you, go along the journey.
Yeah, and I'll take 1 second. People often ask about the timing of these projects, right? And so it is an annual award. So, if you think, hey, we're going to undertake a project, or we have a economic development project coming to our community, or we're trying to recruit it to our community, how do we start this process? And I think, the first step is dialogue. Reach out and let's start that dialogue. Because if you think this project's going to qualify and we want to do it, we need to get ahead of it and kind of get it out there in the marketplace with other CDEs and make them aware of it, so they're kind of got it on their list of projects they're interested in looking at if they receive allocation. So Tyler, any other saved rounds?
No, I think you addressed everything well there. So feel free to ask any questions. I know we only had 30 minutes documented, so if people have to go, we certainly understand that, but we'll stay around for a while to answer any questions.
Yeah, and you have our email and contact info. So please, if you've got any questions or want a copy of the presentation, please don't hesitate to reach out. So we appreciate your time this afternoon and look forward to hearing from you. And as Tyler said, we'll give a minute here to see if anybody has any follow-on questions.
I have a question.
Yes, sir. Please proceed.
So who are some of the big, what like industries are some of the biggest partners in getting these projects, bringing them to the forefront, bringing them to y'all? May I think of, some cities and I'm sure cities are doing this to really varying degrees. Um, um, Real estate professionals, I would hope. And if you could speak to they're community, like place-based community developers, economic developers. If y'all are seeing any if that's much of a profession, what are y'all seeing as far as people who try to get these projects into specific areas?
Sure. So I guess I'll start off and then I can let Tyler take it from there. Yeah, here in Alabama, I think a lot of the transactions we are working on come from a couple sources. Definitely economic developers, be those city economic developers, county or regional authorities, or even those employed by, power companies. We talk a lot to economic developers. Um, Believe it or not, other community banks, lenders across the region, we refer, call us all the time and say, hey, my customer, they make pipe and they're looking to build a new plant in XYZ. Would this be a good qualifying project? Those are some of the people we see. Then there are, to your point, real estate professionals out there that are aware of the program, and they look at, when they're undertaking their own project. Hey, we're going to go build a new grocery store, building and have a triple net lease to a Publix. Let's look at the new market tax credit map and try to make a determination of, locating this new grocery store in a qualifying census tract and a food desert. So that's, some of the referral sources we see from people working in these projects. Tyler, you want to add anything
So
to that?
I think you hit on it. And events like this, right? So our goal is that, after this presentation, to the extent, individuals on this call have projects, they bring them forward. And, that's kind of primary goal for objective for these meetings is to educate, individuals around the state and around the United Bank service area, because there's not a requirement that we're only going to look at a job from a, economic development officer. If you reach out to Alex and the project works, we'll certainly work with you on it.
Yeah, I mean, that's a good point. Tyler, it's often, and even then, it's sometimes referrals from other projects
Yeah.
that we've helped in the past. And somebody else says, hey, how did you build your new plant? And they say, I went through this really painful process called new market tax credits, and they got it done for me. Then our phone rings. So hopefully that answered your question.
It did. I have one. Thank you so much. I have one more question, and it's like completely unrelated to that, I think. But so the Federal Reserve branch of Atlanta, their Fed Communities program, follow the stuff they put out. Is there any role that they play in in helping with these type of projects? It may be a little outside, but I was just curious if y'all ever have any interaction with them in that program or any others.
I mean, we do have interaction with the Federal Reserve out of
On these
Atlanta.
projects. I mean,
Yeah, but not really. I mean, these projects are all done through Treasury, so the Fed doesn't really play a role.
And Alex, I would add to that, the nice thing with new markets is really the federal government is really only involved in allocating the tax credits to the CDEs. They get to pick the deals, and really the projects don't have any specific interaction with like the Treasury Department or anyone else. So it's not, like USDA and some of the other programs, there's, approval processes and other things that can be burdensome with, working with various federal offices. Whereas on the new market tax credit program, it really is up to the CDE. So there isn't, I know United Bank eagerly works with the USDA and others on projects and the SBA, et cetera, but there's no required kind of federal involvement at the project level with government institutions.
Thank you for clarifying. Yeah, and I was coming from the like direction of thinking about like the whole of government approach and how, like these are multi win situations for everybody, and so so many partners maybe at the federal level maybe want to be involved to help carry out their mission and get wins and do anything to help with resources. But thank you.
Any other questions? All right, well, if something pops into your mind afterwards, please don't hesitate to shoot us an email, give us a call. We'd love to answer questions and talk more about the program. But otherwise, we appreciate your time this afternoon and look forward to talking in the future. Have a great afternoon, everyone.
Thank you all.